Santosh Rao is Head of Research at Manhattan Venture Partners and joins us now. Fantastic to have
Thanks
you
for having
on
me.
the show. So you invest in companies pre-IPO.
Absolutely.
You passed on Beyond Meat, and we'll discuss why you chose to do that. But what do you think when you see a company before the lock-in period has ended, deciding to sell more stock 3 months after it IPOs?
That's totally normal. I mean, yeah, it's not nothing wrong with that. You know, because stocks run up 700%, so it's entirely possible or good that they are cashing out. They are getting some liquidity. But that doesn't mean anything bad. I mean, it's like the stock, to the fact that it provides more supply, that's been the big problem with this stock. The supply-demand imbalance, the scarcity factor. I think to the extent that this brings more stock to the market, that's good overall in the end.
But for those that are saying, you know, they should have done less than a 3 million versus a, what, 125 actually fresh stock, newly issued stock here, because maybe they should be raising money that could be pumped back into the business. Is that a valid argument here, or are people just bitter perhaps that they didn't invest in Beyond Meats after the IPO?
No, I don't think that's an argument. You know, it's totally fine what they're doing. There'll be more shares coming to market in October when the options expire, so that'll provide more liquidity. So that's what we've seen with our portfolio companies. When the IPO expiration, when the lockup expiration happens, there's more supply, the stock pulls back, then it has to resettle and all that. So I think all this thing is totally fine. It's in line with what we expect with new companies. And the fact that this company is doing very well, I think it takes away any negative factor about selling early. So I think that's fine. These are the early investors that have been around, so providing some liquidity is totally fine.
Yeah, I'm kind of on your side. This is a 10-year-old company as well. For some of those that didn't actually cash in at the point where it IPO'd, this is about actually taking some profits here and taking some money out, perhaps buying a house or something. Who knows? Why didn't you invest in Beyond Meat?
Yeah, I mean, we had so many other options, and there was no visibility. We thought it's just a new area, very nascent. We didn't know whether it was a fad or something that'll catch on.
Do you still know whether it's a fad or whether it will catch on? Because those that look at this and say it's completely overvalued argue that it's still faddy and it's not going to grow the same way as perhaps plant-based milk has become, what, 10% of the market?
No, I think there is a market for this. It's a very small percentage of packaged meat right now. It's roughly 2%. There's a huge market ahead. There are people who they don't eat meat, they don't like meat, and there's a whole generation, the millennial generation, that are environmentally conscious and they like health food and all that stuff. So this kind of plays into that market. So I think overall there is a market, but let's just see. I think valuation is way ahead of itself, needs to pull back, needs to rationalize, and there's new competition coming in, so the market's not factoring that in already. So I think all that considered, I think the discount, a little bit of pullback is warranted.
When you say a little bit, what do you mean? Because if I just put this into basic numbers, this is right now a market, $2–3 billion. The market cap of this one company is $15 billion. Now, to me, that says that's way more than a growth stock or a growth opportunity. That's completely bonkers.
Yes, yeah, it is.
Define little pullback.
Well, the stock that's growing, the revenue's at 300%. Okay, you can give it a little premium right in the beginning. Let them execute. So far, they have executed. So I think the market will give them the benefit of doubt. But trading at 30 times sales is not warranted. So it needs to pull back to maybe like 15 to 20 times. So you're looking at, you know, roughly around 100, 120 bucks per share. Would be that would be more rational. It can be justified. But then we've seen with these startups, you know, they have tremendous potential ahead. The market's betting on the future, and this company is the most public branded name out there, pure play. I mean, the other guys are coming in. Lack of options. I think that's what's driving it. The scarcity factor and the fact that it's a premium company in a growing market. That's all playing into play.
What's the most exciting segment that you're investing in right now? Because you've invested in things like Spotify, Lyft, SpaceX. I mean, it's a hugely exciting part of the market. What do you think right now? And are valuations perhaps even before these companies get to market too high?
Valuations are kind of rationalizing a little bit. Our next big thing is Airbnb. We are big in Postmates. We have a few other smaller companies. There are a whole bunch of companies out there, niche companies, a lot of enterprise software companies. Those are they're below the radar. People don't know about it, unlike the B2C companies. So there are tremendous opportunities out there. The valuations are rationalizing now. The market is more, when the bankers are more prudent, they don't want to go ahead of themselves.
Which I think is a good thing.
Which is good good thing. I think overall, I think this whole pullback is good.